Hey everybody, welcome to this video. We're talking about income taxes. How much do you pay in income taxes? And three key benefits so that you can reduce those income taxes. Benefits to business owners, real estate investors. Enjoy. Today we are talking about taxes. How much do you pay in income taxes? Now, a couple of things. This video and this podcast episode, it is not professional tax advice. I am not a professional accountant. I have never even played one on TV. So do not take this as professional tax advice. It is always a good idea to talk to a tax professional, talk to your CPA, your accountant, and run by them what you should do because each person's situation is different. So it is also not about one particular person. So taxes are in the news right now because of our president and his tax returns. That's not what I'm discussing today. I am going to discuss what this episode is about, is talking about the tax code and the many benefits in that tax code for real estate investors or business owners. So the reality is that we have a tax code in our country, and based on how we work, how we own businesses, what investments we make, that tax code then determines how much tax we owe, whether that's at the federal level or at the state level. And so that code, in my perspective, essentially rewards those people that do what the country wants. If we're talking about the federal level, so the country wants certain things to happen so that the economy can grow. People that do that get rewarded, and people who don't do that don't see those rewards. The tax code, in my mind, is kind of like the rules to the game, right? I can complain about the rules. I may disagree with the rules. I may really like the rules, but in the end, my opinion of the rules really doesn't matter. Those are the rules to the game. So the tax code is what it is. Now, I'm going to operate my business to succeed or win at the game according to those rules. So here are three major benefits for us as business owners or real estate investors that greatly reduce our tax burden so that we pay less in taxes. All right, number one is before tax expenses. Now think about this. This is true for all business owners. So if you are filing your taxes, if you haven't ever filed your own taxes, this is a side point. It would be a good idea to dive into the IRS website and look at these tax forms, because you'll get a better grasp for, the Schedule C, and if you own your own business, what that filing is like and what they reward for the Schedule C. If you're owning rental properties, it's the Schedule E. What is rewarded on a Schedule E? What benefits can you get from the Schedule E? What consequences are there for the different schedules versus W-2 income? So I'd recommend you do that research. You'll be glad you did if you don't feel like you have a good understanding of it. Okay, real quick, before tax expenses. So as a business owner, we can put expenses or write off expenses, and that gets deducted from the income of the business before tax is figured. As opposed to a person who has a job and W-2 income, and then after that income is figured and their tax is figured, then they make those expenses. So as an example, this is going to be a big example so that it's easy to see. Let's say a person wants to buy a truck and they're going to pay cash. They've saved up their money. They've been a big Dave Ramsey listener for years, and they want to buy this truck. If they are a W-2 employee, then they receive their income The government figures their income and figures the taxes based off of it, and then that person goes and buys the truck. So, for example, if they make $100,000 a year, they're going to pay tax on $100,000 a year, and then the money they have left over, they'll go buy their $30,000 used truck, right? Earn $100,000, pay tax on $100,000. What is left over, they buy the truck with. A business owner will earn $100,000, and then the business will buy that truck, and it will be an expense to the business. So they buy that $30,000 truck. That expense means that the business only shows $70,000 worth of income, and the tax will be figured off of the $70,000 income. So the business owner, both people have a truck. Both people have a $30,000 truck. Both people earned $100,000, but because the business owner is able to write that expense off before taxes are figured, the business owner owes tax on $70,000 of income, as opposed to the employee who owes tax on $100,000 of income. That is a big difference. If you include other expenses in there, that adds up very quickly. So before tax expenses, that is a huge benefit to owning your business. All right, a couple that are specific to real estate. So benefit number 2, depreciation. Depreciation is a write-off where the tax code says that what you own, that rental property you own, over time deteriorates and will lose its value, essentially. In reality, that's not true. If you have owned a house for 20 years, as long as you have taken care of the house, that house will most likely go up in value over that 20 years. But according to the tax code, you get a write-off every year as it loses value. So that means, and you figure depreciation different ways depending on what the expense is, but for this simple example, I'm just going to use the property itself. So a rental property, if you use the straight line depreciation, you're going to split that cost of that rental property up over 27 and a half years. Why 27 and a half? I don't know. Those are the rules. That's what we live by. So if you take a $100,000 house, you buy it for $100,000, then you're going to divide that $100,000 by 27.5, and each year you will be able to write off that amount. So that amount will be an expense on your Schedule E, but it will not be money that you actually take out of your pocket. And this adds up over years. So if, as an example, if you buy a $1 million portfolio, which is not unheard of, is not that difficult if you're building a portfolio of rentals, and you depreciate that straight line depreciation over 27 and a half years, then that means every year you write off $36,000. So every year, let's say this $100,000 example, if you make $100,000 on your rentals, the government and the tax code gives you a write-off of $36,000. And so the actual income you would show is $64,000. So you would be taxed on $64,000. Your bank account is going to receive $100,000. That's another really big difference. If you don't use straight line depreciation, you can actually receive more depreciation in those upfront years. So you could reduce your income even more on paper on your tax return. Your income in your bank account is still going to be what it was originally. So that's a huge benefit. If you make $100,000 and you only pay tax on $64,000, that's a good deal. Additionally, if your portfolio is $2 million, $3 million, if your portfolio is $3 million and you write it off over 27 and a half years. For 27 and a half years, you get $100,000 a year that you don't pay tax on. That's a pretty good deal. I'll take that deal. All right. And the third benefit. There are many more, but these are just the three we're covering today. The third benefit. Cash out refinance money is tax-free. Okay, so if you do, so many people like the BRRRR strategy today, and if you do that and you own properties for a while and then you do a cash out refinance, let's say you have $1 million in your portfolio, you owe $500,000, you're going to do a cash out refinance where you get a loan for $700,000 for this example. Well, at closing, all the previous loans will be paid off, your $500,000. You'll have a new loan for $700,000. And so after you pay off the old loans of $500,000, you receive in your pocket or your bank account $200,000. Because it is a loan, proceeds from a loan, that is not income. So that is not figured on your tax returns as income. Therefore, it is tax-free. So you receive $200,000 in your bank account, and it's not reported as income on your taxes. That's an additional good deal. With the BRRRR strategy, you are creating value. So if you buy it for $60,000, you put $10,000 into it, so you've spent $70,000, and then it is worth $100,000, let's say, with the standard 70% rule, you have created $30,000. As you do that, as you continue to create those chunks of $30,000 in equity, when you pull that out with a cash out refinance, that is not income that is taxed, even though it is new cash in your bank account that you have created. So that is another awesome benefit to real estate. You can't do that with stocks. All right, so the three key benefits, huge benefits. Number one, as a business owner, you can deduct before tax expenses, things you would spend anyway, but because you're a business owner, it's deducted from your income before you figure your taxes. Number two, as a rental owner, you figure depreciation. It's a write-off on your taxes that you never actually spend. Number three, cash out refinance is money that you put in your bank account and you never report as income. All right, those are huge, huge benefits. So the point of the whole title of this episode is how much are you paying in taxes? And I would encourage you, if you are paying a lot of your money in income taxes, then quite possibly you are not doing what the federal government wants you to do to build the economy. So look into these rules and start doing more things that they want you to do so that you get those rewards. And those rewards are lower taxes. So it's not manipulating the system. It's not some loophole. It's not some cheating thing. It is a reward they give you for doing what they want. So start a business, own rental properties, create equity in your properties, and by fixing them up and making them better. Do those things and you will be rewarded, and you will pay less in your taxes. All right, if you want more information on this, there's a video I did a while back on my YouTube channel. I'll put a link to it in the description and show notes. And you can reach out to me with any questions. Reach out to me at chad@truewealthinvestors.com. I appreciate you watching this video. If you have benefited from it, please like the video, share it with your friends so that they can benefit from this information too. And If you don't mind, help me out. Subscribe to the channel so you don't miss upcoming videos and additional content. Thanks.